Our Market Monitor guest tonight predicts that in the new year, many American companies will start spending their cash troves, and many of them will use the money to pay bigger dividends and to buy back their stock. He's Ed Perks, portfolio manager for the $80 billion Franklin Income Fund, a unit of Franklin Templeton Investments. Ed, welcome. Why are you convinced that companies will do something that they really haven't been doing all that much so far?
Yeah, good to be with you, Tyler. You know, the last several years, as I think can be expected coming out of the financial crisis, companies were really more focused on their balance sheet. So we did see a lot of the attention, not just building up the cash balances, but also extending debt maturities, creating a nice runway of liquidity. And now I think we've really seen companies start to shift that focus and to some extent even go completely the other direction with a feeling that, look, these are still, even though rates have moved up somewhat, these are still near record low all-time debt financing costs. Let's take advantage of that. Let's lock these rates in for longer term and let's pay dividends and let's buy back stock as a way to enhance shareholder value. So, you know, we do think we have seen a transition and we expect that to continue into 2014.
So, Ed, you have a couple of stocks to tell us about that fit that description. At the top of your list, you have BP. It has a very rich dividend, 4.5%, but it's a controversial company. Tell us why you like it still.
Yeah, you know, we have seen BP actually recently increase their dividend. And as you said, they've been very focused on dealing with the tragedy from 2010 in the Gulf of Mexico. And through this entire process, it's led the company to, in many respects, kind of rationalize their asset base and refocus around their core assets. And as we now are at a stage where the company's really focused on moving forward, we think we're going to see better returns from many of their new projects that have been kind of developed these last couple of years and will really start to make an impact in 2014 and beyond. So, you know, we expect good cash flow from BP and continued dividend growth.
Another one you like is Dow Chemical. Why Dow and not, say, DuPont or any of the other big chemical companies? Yeah,
well, you know, I would say first that there are many other companies in the sector that we do like, and there are some themes that I think are important. You know, one of the things that certainly has been positive about this overall economy in 2013 is that we finally have an important end market, the housing and construction related end markets, starting to contribute to economic growth, starting to contribute to job growth. So Dow Chemical in many aspects is a play on that important end market, as well as the automotive end market, which has continued to show some nice strength. The thing that I like about Dow is that you do have kind of self-help measures, if you will, a company that does have a portfolio that they can look at and look for opportunities to divest maybe non-core areas, and we think they're going to use that capital that's generated from that divestiture of certain businesses to refocus the company and to reward shareholders through dividends and share buybacks.
So let's move away from some of these industrials. You have Coca-Cola as another one of your stocks on the recommended list. Now, here's a company that's been struggling lately. Make the case why this is a buy at $40 a share.
Well, I think it's a good example of our focus, even though we have the market as a whole hitting all-time record highs for the Dow and the S&P. I think you can look more specifically at individual companies and find opportunities, buy good companies at more attractive valuations. And, you know, Coca, until recently, it has popped up a little bit over the last month, but investors were, I think, a little bit disappointed with recent results, particularly some of the weakness in Brazil and Mexico. When you look past that, actually, the U.S. market and many other developed markets were performing a little bit better for the company. So we see better prospects and better comparisons going forward for Coke. That's one of the things that really interests us. It does have attractive dividend yield. And this is probably one of the better examples, just a very high-quality company. They have an outstanding share repurchase program with more than 10% of shares outstanding targeted for repurchase.
We have to leave it there, alas. Ed, do you have any disclosures personally or for your funds with respect to these stocks?
No, you know, I own all of these stocks through my holdings in the fund.
All right, Ed, thank you very much. Ed is the portfolio manager for the Franklin Income Fund.